Right now, the world's wealthy are making a massive bet. They are putting the wealth they've accumulated over generations on the line, choosing which asset class to side with. You still think this has nothing to do with you, or worse, if you find yourself on the wrong side of this bet. It's no exaggeration to say your financial class could be locked in for the next 20 years. Why? You'll find that the most frequent questions I've been getting are seemingly unrelated. First, gold has risen so high. Is it still worth buying? Second, US stocks have hit new highs. Is it still worth buying? One question is about gold. The other is about US stocks. But in reality, these aren't two separate questions. By the end, you'll find they are the same question. And when this question starts getting asked so many times, what does it mean? It means we have entered the first major wealth reshuffle since 2008. What does that mean? Hello, everyone, and welcome to Stewardship Finance Academy. It's a channel that helps you become a confident investor by breaking down complex financial concepts and market news into simple, actionable insights. So, everyone, is gold a safe haven asset? In troubled times, people buy gold. This so-called safe asset, gold, soared 62% last year. Does this mean everyone is shifting their money into safety because they believe the world is becoming chaotic and the economy is facing a potential crash? But what about the other side? Stocks a risky asset. In that same period, US stocks also climbed 10%. If we only count the rebound since the last crash, they're up over 30%. Does this mean the market is actually optimistic about the US economy? In other words, these two questions boil down to one. For those who didn't invest last year and didn't make money, can they still chase these gains? Whether you bought gold because you were bearish or US stocks because you were bullish, if you invested, you basically made money. This is the question retail investors are asking. They don't realize the seriousness of the situation. Everyone, why is the market betting on both the safe haven asset, gold, and the risky asset, US stocks? It's like a casino. If the economy is truly so strong, why is there such a desperate rush for gold? If a crisis is truly imminent, why is the US stock market rising so recklessly? These two things are happening simultaneously, but they cannot both be true. It means one of them must be a monstrous lie. Why are all the experts talking about a US debt crisis, yet the US itself seems unfazed? In recent months, the US has borrowed an additional $2 trillion. How can they owe the entire world money and still see their stock market soar? This doesn't seem like market logic. To me, it looks like a plan orchestrated by powerful forces. I'm telling you, the truth is far colder and more brutal than you can imagine. Your choices will determine whether your wealth is crushed or whether you ride the wave. If you don't want to be a victim of this game, or if you even hope to find an opportunity in it, then subscribe to my channel. Red if you're worried you'll forget this. Like this video so it's saved to your playlist. First, the simultaneous rise of safe and risky assets is a contradiction. But it is theoretically possible. For example, during a war, people buy gold for safety. Meanwhile, if US economic data is strong, people from other struggling countries might buy US stocks as their safe haven. In that sense, US stocks can be considered a safe asset in chaotic times. But is that what's happening now? You'll notice that after the Russo-Ukrainian war broke out in 2022, gold actually fell. For 2 years, it kept hitting a resistance line and couldn't break through. It wasn't until 2024 that it began to rise again. Gold's fastest growth actually happened last year. In other words, gold's movement doesn't seem directly related to war. Honestly, if you want to run away with your money in a war, holding gold is more convenient than holding US dollars. So here's the key point. Why has gold risen so much? It seems to be because the US dollar has also been plummeting. Gold isn't acting as a hedge against war right now. It appears to be a hedge against a US dollar crash, or more precisely, a US Treasury bond crash. Many people say that if no one buys us debt, the US will face a crisis. Right? But as I've said before, this isn't a crisis for the US. For now, even if the whole world stopped lending new money to the US could still repay its old debts. How the Federal Reserve can effectively print its own money and lend it to the US government. So why would the Fed just watch US debt plummet and not step in? In fact, over the last couple of years, the Fed has reportedly been selling US debt, causing the debt and the dollar to fall even further. Here's the point. A lot of people think the US government and Americans are the ones footing the bill for this, right? That's laughable. If Zimbabwe's bonds collapsed, it wouldn't affect us. But this is the United States. Imagine you owed the entire world an astronomical sum of money, an amount you, your children, and your grandchildren could never pay off. What would you do? Work hard to pay it back? No chance. So would you declare bankruptcy? Impossible. America's credit would collapse. In other words, paying it back or going bankrupt are not the real solutions. So when the debtor won't pay, who's ultimately responsible? The lender, of course. Everyone, what's happening? The US is experiencing severe inflation. US Treasury bonds have plummeted. The US dollar has plummeted. What does that mean? Inflation means a loss of purchasing power. Imagine you owed a bank $1 million 30 years ago, and today you finally paid it off. Have you truly paid it off? If $1 million 30 years ago could buy a house that's worth tens of millions today, wouldn't you actually owe the bank tens of millions in today's money? But you only paid back $1 million? Aren't you using devalued money to repay a valuable debt? You've effectively defaulted on most of it? Now, magnify this logic hundreds of thousands of times and apply it to the United States. What the US owes the world isn't a number. It's the purchasing power of that number. To buy the same amount of oil, food, and goods today would require, say, $10 million. But the US only pays back the $1 million it originally owed, so hasn't 90% of that debt effectively been defaulted on? And how do you trigger this kind of inflation and devalue your currency? During the 2020 pandemic, the Federal Reserve printed money without limit. Inflation skyrocketed. And what about last year? They started cutting interest rates and imposing tariffs before inflation was even tamed. The US government was even shut down, so no one was officially counting inflation. From this perspective, inflation doesn't just tell you if the economy is doing well. The more important factor to consider when evaluating the economy is the unemployment rate. Inflation, in this context, could represent the extent to which the US intends to default on its debts. The more inflation, the less real value it has to repay, right? And what about US Treasury bonds plummeting? It seems like no one is lending to the US government. This sounds bad, right? It means the US has to pay higher interest to borrow. But who is lending money to the US? The whole world. Most countries hold their foreign exchange reserves in US Treasury bonds. Now that the price of those bonds has plummeted, haven't the world's assets suddenly devalued? We saw US banks go bankrupt because their bond assets plummeted. If US banks can fail, what about the rest of the world? Think about it. What if you bought US Treasuries during the 2020 pandemic, when prices were at their highest? You would have then faced the Federal Reserve's rate hikes and balance sheet reduction, which drove bond prices down. Your assets would have shrunk significantly. After 2020, a popular US Treasury ETF shrank by over 50%. So, when you panic sell your bonds at a loss, the market crashes even more. At this point, the Federal Reserve might just come in like an angel, claiming to stabilize the market and buy back those same bonds from panicked sellers at extremely low prices. Think about this possible three-step process. First, the US government sells bonds to you at a high price. Then, the Fed steps in to dump the market, crashes the price, and buys your bonds back at a low price. Finally, the US government pays the Fed, and the Fed returns the money to the US government. So, in the end, aren't you the one footing the bill? The entire process is public. They claim they're raising rates to address inflation. They claim they're buying assets to prevent a financial collapse. But aren't the world's creditors the ones losing money? And now the dollar is plummeting. The principle is the same. The US dollars the world painstakingly earned are now devalued. If the dollar devalues 20% against the euro, what does that mean? It's like lending someone 1 million euros and they only pay you back 800,000. So, is all this inflation, the plummeting dollar, falling bonds good or bad for the debt-ridden US? Are you the one footing the bill? This suggests the US debt crisis is a crisis for the creditors, not the debtor. The collapse is for the lenders, not the borrower. Do you understand? The world's hard-earned money is shrinking. And at the same time, safe haven gold and risky US stocks are both rising. Is your money shrinking even more? Just because you don't understand investing isn't a reason not to invest. Yet, many people's understanding of investing is based on insider information or buying low and selling high. And what happens? They end up buying high or catching a falling knife, because they're using retail investor methods. First, we don't have inside information. Second, we don't need to predict when a bubble will burst. Only do one thing: ride the bubble and get out before it crashes. Our team is in the market for stocks you're afraid to buy. When you panic sell, we've already locked in profits. It's not because we're bold. It's because we have a bubble-hunting guerrilla warfare system. It identifies the signals of major investors with an automated profit-taking mechanism. We spent 3 months putting this complete system into the free stock investment Masterclass. Today, you don't have to pay $400. You don't even have to pay $1. If you're a subscriber and you really want to survive, I'll give it to you. It's a public service class. Those who were too slow last time won't get a spot this time either. So, click the first link in the description to secure your spot immediately. Don't wait until the bubble bursts to remember you had this spot. You'll notice that since the US began raising rates and shrinking its balance sheet, central banks around the world have doubled their gold purchases. Why? To save themselves. With their dollar assets depreciating, they have no choice but to switch to a safe haven asset. So how can gold, the safe asset, and US stocks, the risk asset, rise at the same time? It's possible if they are being bought by two different groups of buyers. It's buying gold. Central banks around the world. Who's buying US stocks? Retail investors worldwide? So, the question arises: is gold replacing the US dollar? When the whole world buys gold, will the dollar collapse? On the surface, yes, central bank gold purchases have doubled. But if you look closer, you'll discover a cold truth. In reality, each country is only buying a tiny amount. For example, China has been one of the most active buyers, but its average annual purchase is less than 100 tons. Official data shows China currently holds over 2,000 tons of gold. But do you know how much the US claims to hold? Official data says over 8,000 tons. This figure is often questioned, but regardless, the world believes the US has over 8,000 tons. This means if China wanted to match the US, it would take 50 to 60 years of buying. And if the world accelerates its gold purchases, the price of gold will only rise even more. So the US isn't afraid of others buying gold. When the whole world buys, the price of gold goes up. And the value of America's 8,000 plus tons of gold assets becomes even more valuable, while its debt invisibly shrinks. Is this a good or bad thing for the US? Now, the crucial question. Gold has already risen so high. Will it continue? In the past 50 years, gold has had 5 major bull and bear markets. First, in 1971, when the dollar was decoupled from gold, everyone lost faith in the dollar and rushed to buy gold. Around 1974, gold entered a bear market. Why? The US dollar was pegged to oil. Then, around 1978, a bull market started again. Why? The Soviet Union was challenging the US for world dominance. In 1981, another bear market. The US won that competition, and the dollar regained dominance. Then, around 1985, Japan experienced incredible growth. Housing prices in Tokyo could reportedly buy the entire United States. Many American companies were acquired by Japan. The dollar was in danger of being replaced by the yen, and gold entered a bull market. A few years later, after the Plaza Accord, Japan was gone. The dollar rebounded, and gold entered a long bear market. Till 2000. The US dot-com bubble burst, and European countries created the euro. The euro was also challenging the dollar, so gold entered a bull market. It wasn't until 2012 that gold entered a bear market again. Why? The European debt crisis erupted, and the euro also died. So, you see the pattern? Every time gold enters a bull market, it seems to be because the dollar is in trouble or another currency is challenging its dominance. Now, after the 2020 pandemic, the US printed money without limit, directly driving the dollar down. Gold started to rise, stopped in 2022, when the US began hiking rates. But starting in 2024, the dollar plummeted again, and gold rebounded. That rise was one of the fastest and largest in history. The relationship between the dollar and gold is like a seesaw. When the dollar falls, gold rises. So is this gold bull market ending? We should ask the reverse. Has the dollar's decline ended? First, will the Fed continue to cut interest rates? Are these cuts just the beginning? Is the US unemployment rate getting worse? If so, it's highly likely the Fed will continue to cut rates. Furthermore, the Fed recently stated it might stop shrinking its balance sheet. If it starts expanding it, again printing money, won't the dollar become even cheaper? Second, will US inflation continue to rise? If the 2022 rate hikes didn't curb inflation, do you think the current rate cuts and tariffs will? Third, will US Treasury bonds continue to fall? The US has sold over $2 trillion in bonds in just a few months. While short-term Treasury bonds have found buyers, long-term bonds reportedly remain unsold. The US government has mostly only borrowed short-term debt, not long-term. In other words, for gold to enter a bear market this time, several conditions would likely have to be met. First, US inflation must end no more tariffs, interest rate cuts, or money printing. Second, the US dollar's exchange rate must stop falling. Third, long-term US Treasury bonds must find buyers again. Otherwise, the gold bull market will likely continue. So, while gold may be seeing a pullback after a major run-up, a pullback is acceptable to us. So far, gold's long-term trend hasn't done anything wrong. But one thing seems certain. Countries around the world are betting on gold as a safe haven asset. The World Gold Council even suggests that the United States smuggled 600 tons of gold into its own vaults before the tariff war in 2024. And what about the safe haven asset of US stocks? Who's buying those? A question to ponder. How long will the rise in gold and the decline in the US dollar last? Leave a message and discuss it with me. Okay, due to time constraints, I have to end here. If you don't want to miss out, subscribe to my channel and turn on the bell. Then share the video generously. I sincerely wish all the brothers and sisters who liked this video speedy financial freedom. If you have any questions, please leave me a message. If you found just 1 or 2 useful sentences today, I will be satisfied. Okay, see you next week. Bye.